Welcome to TalkTickers, your direct line to the most critical insights from the latest earnings calls. Today, we're doing a deep dive into Coor Service Management's Q2 FY25 results. They dropped pre-market July 14th, 2025.
And our mission, as always, is to cut through the noise, really pull out the key bits of info you need to stay well informed. We'll explore what drove the market's reaction too.
Okay, so let's get straight to the numbers then. Coor Service Management reported Q2 net sales of SEK 3.199 billion. That actually beat the street's consensus, which was around SEK 3.14 billion. So, good news there.
But here's a twist. Earnings per share came in at SEK 0.70, and that fell short of the SEK 0.82 consensus.
Right, so a bit of a mixed bag on the surface, yeah. Revenue beat, EPS miss.
Exactly, but this is where it gets, really interesting. Despite that EPS miss, the underlying operational story looks quite compelling. Organic growth actually swung positive, 3%, which is a pretty significant turnaround.
3%, okay.
And their adjusted EBITDA margin, that's their core operating profit before, interest, taxes, amortization, it inched up 10 basis points, 0.1%, to 5.2%. And maybe most importantly, cash conversion on a trailing 12-month basis hit 88%.
88%.
Yeah. And the market clearly saw these operational improvements as a strong signal, because the stock moved up significantly. Okay,
so that 3% organic growth, that isn't just a number, is it? It feels like a real reversal, especially given where they've been.
It is.
And seeing that EBITDA margin expand to 5.2%, it kind of confirms their efficiency talk isn't just talk. Something's working.
Yeah, absolutely. And management was pretty clear about this on the call. They explicitly linked this positive organic growth and the stable improvement in the EBITDA margin directly to those operational efficiency initiatives they've been talking about.
Right.
It's a continuation from last quarter, suggesting these efforts are, really starting to bite and gain traction, not just cost cutting, but actual improvement.
And the cash story, like you said, 88%. That's seriously impressive. For you, the listener, that means Coor's turning nearly 9 out of every 10 kroner of profit into actual cash they can use, which is key.
Absolutely key. It's a huge indicator of financial health. Right. And think about where they were 81% last quarter, but just 57% 2 quarters before that.
57? That's a huge jump.
It is. They're almost at their 90% target now.
Okay.
And you can see this improved cash efficiency really clearly in the working capital figures. They had a significant reduction, SEK 113 million, in working capital during the first half of 2025.
Compared to last year.
Compared to a SEK 142 million buildup in the same period last year. It's a massive swing.
Wow.
This has basically restored their net working capital to a negative 7.5% as a percentage of their last 12 months sales.
Okay, break that down. Negative working capital, what does that mean for a company like Coor?
Well, for a service business, it's kind of the holy grail. It essentially means their customers are paying them before Coor has to pay its own suppliers. So their operations are being funded by their customers, effectively. It's a hallmark of really efficient working capital management, and it generates a lot of cash.
Got it. Okay. And the balance sheet, leverage.
Leverage clocked in at 2.9 times. That's a slight tick up from last quarter, but that was mainly due to dividends being paid out. So understandable.
And what about shareholder returns? Any update on the buyback?
Yeah, they confirmed the SEK 50 million share buyback plan, the one that runs until March next year, is still valid. It got postponed because of the internal reorganization they were doing.
Right.
But they plan to get it back to the board for approval after the summer. So it signals they're still committed to shareholder returns once these operational changes are, fully bedded in.
Okay, let's pivot a bit. Talk about their contracts. Management highlighted a stable portfolio.
Yeah, they did. It said about 60% are small and medium-sized contracts, which often have that kind of open-ended nature, more stable. And they also mentioned winning around SEK 300 million in new contracts in the first half.
Which helps offset.
Which more than offset about SEK 100 million in contracts that ended. So good net wins there.
And any big ones stand out?
Definitely the extension of the Volvo Cars IFM contract in Sweden. That's a long-standing big relationship.
IFM being Integrated Facilities Management.
Exactly, where Coor handles a whole bundle of services. These are sticky, important contracts. But what's maybe even more fascinating is a new property contract they won with a company called REAB.
Okay.
The interesting bit, it was awarded based 100% on quality conditions in the tender, not just the lowest price.
Ah, so not just a race to the bottom on price.
Precisely. It really validates Coor's ability to deliver high-quality service, which is exactly the space they say they want to compete in. It's a strong proof point.
Okay, let's unpack this country by country now, because Norway's numbers, well, they really jump off the page. 23% organic growth.
Yeah. I mean, that's not just good, that's a huge number.
What on earth fueled that? And, how much of that is sustainable?
That's the key question, isn't it? A lot of it, roughly half actually, was driven by unusually high variable volumes. Stuff like maintenance stops in the energy sector.
So maybe some one-off factors there.
Some, yes. But management was careful to point out that even if you strip out those exceptional volumes, Norway still would have seen margin expansion. They put that down to ongoing efficiency work and, importantly, strong new leadership they have in place there.
Okay, so underlying strength too.
Definitely. And what's potentially really exciting long-term is the public sector opportunity there. It's largely untapped for them. Now, public sector deals sometimes have slightly lower margins, but they can be very profitable if it's a quality-focused tender, like that REAB one we mentioned.
Right.
Their philosophy seems to be earn the right to invest in growth. So it sounds like a measured but potentially significant long-term play for Norway.
Okay, moving south to Sweden, things look a bit more subdued there. A slight organic decline.
Yeah, down 0.8%. They cited effects from ended contracts like Saab and also lower variable volumes compared to last year.
But margins?
But despite that little dip in sales, the adjusted EBITA margin in Sweden actually improved, went up to 9.1% from 8.7%.
Interesting. So efficiency gains offsetting volume weakness.
Seems like it. Management noted variable volumes are just hard to predict, tied to the economy. But they also pointed to strong demand from sectors like defense and energy. So it kind of shows those mixed signals you see in the economy playing out. Even if overall volume is soft, certain pockets are strong, and efficiency can still drive profit.
And there's Denmark. That sounded tougher. Negative organic growth, minus by 0.3%, and margin down to 4%.
Yeah, and they also flagged losing a contract, the VUS contract, which is going to hit the numbers from Q4 onwards.
So what's the plan there?
Management pretty much acknowledged Denmark is currently their least predictable market. They were quite open about it. They are actively putting in place long-term efforts to improve management and governance. There's a new CEO, Peter Hasbach, taking over after the summer.
A fresh start, maybe.
Hopefully. Despite the current issues, Coor is still a top player in Denmark. They stress that. And they're still competitive in new bids, helped by their international team. But yeah, it really raises the question, is this the bottom for Denmark? How quick can that turnaround be? It's one to watch.
And Finland, briefly mentioned.
Yeah, just a slight organic decline there, 1% due to some smaller contracts ending. Margins were pretty much flat, in line with last year.
So more stable, less dramatic than Norway or Denmark?
Exactly. Finland seems to be about steady performance right now, provides a reliable base. While they will focus on growth in Norway and fixing things in Denmark, it's about portfolio balance.
Okay, so we've seen the performance across the map, the impact of that operational focus. Let's zoom back out. Strategic stuff. Those big organizational changes announced earlier this year, where are they with that?
All done. They confirmed that changes to central staff are fully completed and were in full effect right at the end of Q2.
And those costs associated with it.
Yeah, the SEK $22 million in items affecting comparability. There was mostly redundancy costs from those changes. But management confirmed those costs should decrease significantly going forward. It's mostly done now.
And the impact? Reducing headcount, any negative effects?
They emphasized that reducing the 130 employees hasn't actually led to detrimental effects. Quite the opposite, they argued. They feel it's sharpened the focus on core operations, core efficiency, and brought HQ costs back to a more, normal level. Leaner and meaner, basically.
Makes sense. And looking further ahead, what should investors keep an eye out for?
Well, they flagged they intend to hold a capital markets day early next year.
Okay. That's usually significant.
Yeah, it should be important. They plan to give more in-depth updates on their future growth path, which markets they'll focus on specifically. It should provide a much clearer sort of forward-looking picture for everyone.
Right. So let's bring it all together then. What does this actually mean for you, the investor listening in? You've got this mixed picture, right? Revenue beat, but an EPS miss. Yet the market reacted really positively. Stock up 6.6% on triple the average volume. Why?
It seems investors pretty clearly shrugged off that short-term EPS miss. They chose instead to focus on the positive signals, the return to positive organic growth, the improving margin, the strong cash conversion, and the fact that the leaner organization seems to be delivering tangible results already.
So fundamentals over headlines.
Exactly. It looks like a shift in sentiment, rewarding that operational efficiency and the strategic execution, even if the bottom line earnings number isn't quite there yet. And, the fact that peers like MIDI and ABM also traded up suggests maybe a better mood across the sector. But Coor's outperformance, that specific jump, signals real confidence in their specific turnaround story, especially when you remember the stock had already bounced back over 50% from its lows back in January.
Right.
It suggests the market thinks these improvements aren't just a blip, they might actually be sustainable.
All right. This is the part of the show where we stretch our thinking a little. Just want to remind everyone, this is absolutely not financial advice. These are just some, let's call them outrageous but plausible trade ideas based on what we've just discussed. Your thoughts?
Okay, well, if you're looking for something bold, how about this?
Okay.
Consider a long position on Coor, but maybe structure it using bullish options, something that gives you leverage to that Norway turnaround story.
Okay, leaning into the Norway strength.
Exactly. The narrative here is that Norway's really impressive 23% organic growth, driven by both those variable volumes and new contract wins, plus that untapped public sector potential. Maybe that's not just a Norway story. Maybe it's a blueprint for accelerating profitable growth across the whole group.
And the outrageous part?
The outrageous part is betting that this success in Norway leads to a complete re-rating of Coor as a company, pushing its valuation multiple up towards those more premium, maybe seen as more growth-oriented facility services players, rather than where it's traditionally sat with slower growth peers.
Plausible if.
Plausible if they can actually replicate that operational efficiency, that focus on quality wins, especially in the public sector, across their other key markets like Sweden and eventually Denmark.
Mm-hmm.
It's basically a bet on them echoing that Norway success story across the whole business, a bet on execution.
Interesting. Okay, so let's summarize. Coor Service Management's Q2. We saw a pivotal return to organic growth. We saw improved margins, strong cash conversion, all seemingly underpinned by those now completed organizational changes. And the market, well, it clearly liked what it saw, looking past the EPS miss to that underlying operational strength.
Yeah, I think this deep dive really shows a company making significant progress on its turnaround plan. Yeah. And it makes you think, doesn't it? If a facilities management company, often seen as maybe a bit traditional, can pull off this kind of operational comeback and get this market reaction, where else might you find hidden operational improvements brewing? Maybe in other seemingly boring sectors, just waiting for their moment to drive some unexpected value.
A great thought to leave our listeners with. Look beyond the headlines. Thank you for joining us for this deep dive. We look forward to exploring more insights with you next time on TalkTickers.